Hey guys, it's Greg Hardy, and I want to welcome you to my channel. In light of the recent stock market activity, I wanted to make a video today that addresses the concerns that you might have. Have you ever heard of the terms crash, correction, or pullback and felt a bit confused or worried? Well, you're not alone. Understanding these terms is crucial for anyone who wants to invest in the stock market. This video is going to cover what these terms really mean and why they aren't always as bad as they might seem. This knowledge can help you make smarter decisions and stay calm during market ups and downs. Let's face it, investing can be risky. Anyone who's been in the stock market for over 5 years knows this because they've seen the ups and downs during the pandemic. Look at the growth of the US stock market, which we'll call the S&P 500, since the Great Depression. The S&P 500 is a list of the 500 biggest companies in the US, like Apple, Amazon, and Google. It's a way to see how the overall stock market is doing. When people say the market is up or down, they're often referring to the S&P 500 since it makes up roughly 80% of the overall stock market. It's like a report card for the US economy. Since 1928, the stock market has mostly gone up. From the 1929 crash to World War II, the 1970 stagflation, and the 2008 financial crisis, staying invested long-term hasn't always been easy. But if you had put $1 in the S&P 500 in 1926 and reinvested all of its dividends, it would be worth about $13,000 by 2023. History doesn't repeat itself exactly, but knowing past trends can help you understand future market behavior better. A stock market pullback is when the market goes down after going up for a while. It's like taking a small step back after running forward. Pullbacks usually are short-term and happen when the market drops between 5 to 10% from its recent highs. Think of it as a pause or a breather for the stock market. Pullbacks are actually pretty normal. They can happen several times a year and usually last for a few weeks. For example, in 2021, the S&P 500 had 5 pullbacks, each around 5 to 6%. These pullbacks didn't turn into bigger problems, they were just short-term drops before the market went up again. One reason pullbacks happen is because investors might start to think that stocks are getting too expensive. They might sell some of their stocks to lock in profits, which causes prices to dip. Other times, some news might make people nervous, like changes in interest rates or political events, leading to a temporary market drop. The good news is that pullbacks often give investors a chance to buy stocks at a lower price. Many long-term investors see pullbacks as opportunities to buy more shares of a good company at a discount. So while pullbacks might seem scary at first, they are normal and a part of how the stock market works. Guys, if you're finding value in this video, please hit that like button and also consider subscribing to this channel if you want to see more content like this. It also helps this video reach more people and can help even more viewers. Thank you. A stock market correction is when the market drops by 10 to 20% from its recent highs. It's more serious than a pullback, but not as bad as a crash. Corrections are like a reality check for the market, helping to cool things down when prices have gotten too high too quickly. Corrections are actually pretty common and can happen every couple of years. For example, from 2000 to 2019, there were 12 corrections in the S&P 500, about one every 1.6 years. These corrections usually lasted for around 4 months, but the market eventually bounced back each time. Corrections can be caused by many things like economic concerns, changes in interest rates, or global events. When investors get worried, they might sell off their stocks, leading to a bigger drop in prices. But it's important to remember that corrections are a natural part of the stock market cycle. While corrections can feel pretty unsettling, they often create buying opportunities for long-term investors. Many people use corrections to buy stocks at much lower prices, which can lead to gains when the market recovers. So while a correction might seem scary, it's really just the market's way of adjusting and finding balance. A stock market crash is when the market falls suddenly and dramatically, usually by 20% or more from its recent highs. It's a severe and often rapid drop in stock prices that can feel like a shock to investors. For example, during the 2008 financial crisis, the S&P 500 fell about 57% from its peak in 2007 to its low in early 2009. Crashes are rare but can be pretty nerve-wracking. They're often triggered by a major economic problem such as financial crisis, a sudden geopolitical event, or a major loss of investor confidence. For instance, the Great Depression in 1929 saw the market lose nearly 90% of its value by 1932, which was a result of both economic collapse and a massive loss of confidence. While crashes are dramatic, they don't last forever. Historically, markets have always recovered over time. After the 2008 crash, for example, the S&P 500 eventually recovered and reached new highs within a few years. Many long-term investors use crashes as a chance to buy stocks at bargain prices, knowing that the market tends to rebound over time. So even though a crash can be scary and painful in the short term, it's important to stay calm and remember that markets have a history of bouncing back. Investing with a long-term perspective can help you weather these tough times and come out stronger on the other side. So now that we've covered pullbacks, corrections, and crashes, it's also important to understand the broader terms of bull market and bear market. A bull market is when the market is rising steadily and investor confidence is high. It's a time when stocks generally go up and people are very optimistic about the economy. On the flip side, a bear market happens when the market is falling, typically by 20% or more, and there's widespread pessimism. Understanding these terms can help you better grasp the overall trends in the market so you're not caught off guard by the natural ups and downs. One of the biggest mistakes people make when investing in the stock market is letting their emotions control their decisions. For example, when the market drops, it's easy to feel scared and sell your stocks quickly to avoid losing more money. But this can be a huge mistake. By selling in a panic, you might end up locking in your losses and miss out on the chance to make money when the market goes back up. Instead, it's better to stay calm and stick to your plan. The market naturally goes up and down, and reacting to every dip can hurt your long-term results. Keeping a steady approach and not letting fear drive your decisions can help you stay on track and make better choices for your investments. Another common mistake is not having a clear investment plan. Without a plan, people might jump into hot stocks or follow the latest trends, hoping to make a quick profit. This can lead to poor choices and uneven results. Instead, it's important to have a strategy that matches your financial goals and risk tolerance. Investing with a long-term perspective and sticking to your plan can help you avoid making emotional decisions and keep your investments on track. To thrive during market downturns, start by sticking to your investment plan. Having a clear strategy helps you stay focused and avoid making emotional decisions. Review your plan if needed, but try not to make drastic changes based on short-term market drops. Investing in quality companies and funds is another key strategy. Look for businesses with strong fundamentals like solid earnings and good management. These companies are more likely to bounce back after a downturn and offer long-term growth. World-renowned investor Warren Buffett views market crashes as opportunities rather than disasters. He believes that market downturns can be a good time to buy quality stocks at lower prices. Mr. Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." He advises investors to focus on the long-term value of their investments rather than the short-term market movements. He also suggests that if you have a sound investment strategy and choose companies with strong fundamentals, a market crash can offer a real chance to acquire valuable stocks at a discount. His approach is to stay calm, remain patient, and take advantage of the lower prices that a market downturn can provide. Diversifying your portfolio can also help. By spreading your investments across different sectors and asset classes, you reduce the risk of a downturn hitting your overall portfolio too hard. Investing in different sectors and asset classes is important because it helps you spread out your risk. What I mean by that is imagine putting all of your money in one type of investment, like just in tech companies. If something bad happens to that sector, you could lose a lot of money. But if you also invest in other areas like healthcare or real estate, your overall risk is lower. Different asset classes like stocks, bonds, and real estate perform differently at different times. When one is not doing well, another might be doing great. By investing in a mix of these, you can make sure that your money grows more steadily over time. This way, you're not just relying on one thing to secure your financial future. Market declines can also be a chance to buy high-quality stocks at lower prices. So if you have some cash on hand, consider investing in undervalued assets. Finally, maintaining a long-term perspective is crucial. Market downturns are usually temporary, and the market often recovers over time. Keeping your focus on long-term goals can help you avoid reacting impulsively. Regularly reviewing and rebalancing your portfolio can ensure that it matches your risk tolerance and goals, helping you make the most of opportunities during market dips. Sticking to your investment plan and not letting emotions drive your decisions is crucial during market downturns. Many people panic during market drops, selling off their stocks and locking in losses, which misses out on potential future gains. Instead, keep a long-term perspective and focus on quality investments to navigate these tough times effectively. Diversifying your portfolio and using downturns as opportunities to buy undervalued stocks can be really beneficial. Remember, markets tend to recover over time, and by staying calm and sticking to your strategy, you can make the most of these market shifts. If you want to learn more about growing your wealth, then check out this video right here. But before you do that, don't forget to like and subscribe. Thank y'all so much for watching. I really hope you liked this video and that you got something out of it. I'll see you in the next one.